Matt Orton, Chief Market Strategist at Raymond James, is with us. Matt, always great to have you on. Thanks so much for joining in. So, the Indian market has started stirring a little bit. It's showing some sign of life, and everyone's really excited about this GST meeting that's kicking off today. You tell us, do you think we're at some sort of or at least close to a turnaround point? And are you looking at any sort of portfolio changes or addition if we indeed get these big GST cuts?
Hi, good morning, Surabhi. It's always great to join. And I think the GST is the right focus. Obviously, there's tariff.
I think we just lost that line with Matt. We'll try and get him back. But yes, the reminder that the GST meeting kicks off. Remember, it's a two-day meeting. And the big overarching reform, as the proposal carries, is that we will move to largely a two-rate structure, 5% and 18% for goods. Matt, sorry we lost you there, but you were saying that that GST is the right focus. Go on.
It is, because it gets back to the fundamental underpinnings of why India, I think, is an exciting long-term opportunity for investors. India is a primarily consumption-based economy, very similar to the United States. And I think GST, the simplification, is a signal to investors that have been concerned over the long term about the regulatory framework, some rules that don't make sense in India. This is a massive simplification. I think it will do a lot to spur the consumer. And I think it can help get enthusiasm back in the market. And hopefully, you'll start to see a tangible uptick to earnings for companies that are exposed to the consumer across the broader market, as opposed to some of the more concentrated gains we've had in India so far this year to some of the winners versus a lot of other companies that have been left behind. So I certainly think it can be very positive. And hopefully it gets foreign investors in particular their attention focused back on things that actually matter longer term to the growth story of India.
Matt, good morning. In the US, are we starting to, are we in the first stages of a bit of a drift lower, a bit of a correction, small, I don't know. Especially the large tech names seem to be deflating a little bit now.
Yeah, Prashant, I think it's a healthy consolidation. Would I be surprised to see a 5 to 10% pullback in what is seasonally the weakest month of the year? Absolutely not. But we are still very much in a secular bull market. And, I continue to think that this market's going to end meaningfully higher than where we are currently on the S&P 500 and for the broader market. Because, again, the earnings that are underpinning the AI story are very much real. So people talk about a bubble in artificial intelligence, but I strongly disagree with that notion. You're seeing hundreds of billions of dollars spent in CapEx that continue to increase against all expectations. I would argue you're starting to see a return on investment across a number of these companies, and there's no leverage being used. You can't have a bubble if there's no leverage cycle, and you can't have a bubble if margins remain consistent and among the highest of all companies in the overall market. So I think there's a lot of durability to this trend. And in fact, when I look globally at attractive investment opportunities, I think this pullback is a great opportunity across the world to lean into some of these artificial intelligence-driven trades that are starting to pull back, and maybe you finally get an opportunity or a bite at the apple if you've missed those trades in the past.
All right. Hi, Matt. Good to see you. Matt, what's your view on global equities? The U.S. market has been rock solid. You threw a lot at it. You have Mr. Trump, who says one or the other thing, some uncertainty with regard to the central bank out there as well, and data is mixed. Do you think the U.S. is getting to a stage where it could be peaking out? And what could that mean for an emerging market like India, which hasn't got any flows? Earnings have been a little bit subdued, but we have been big underperformers.
Yeah, Nigel, I think the key word there is earnings. I think the U.S. has outperformed so many other markets consistently because it's really been the only place in the world where you've had consistent earnings that continue to surprise to the upside. So I do think the U.S. continues to perform well. However, when I look at the full global stage, I'm a lot more excited about emerging markets going forward than I am of international developed markets, broadly speaking. Not only because you don't have the economic growth that you do in emerging markets that's lacking in kind of the Europe, Japans of the world, but when you look at EMs, there's an inflection point for earnings. You've seen that in China. That's why Chinese equities have been so strong. Also, because a lot of US policies are actually spurring reinvestments in semiconductors and onshoring in China, which is almost at odds at what the US policy actually is. And I think India, you've seen earnings weakness, but I do think we're getting to an inflection point. And hopefully, these GST reforms can be one of the reasons why we're going to start to see earnings move higher. So I would lean into, in the Indian markets, lean into some of this weakness, especially as a long-term investor.
So, Matt, leave us with some names, some stocks. You've liked financials, you've liked names like M&M, Interglobe. But tell us, since you're quite convinced on the GST impact, what would you buy from consumer?
So I'm looking at complements to some of my longer term holdings right now. I've actually reduced ICICI in my portfolio just because I have to respect technicals, I have to respect the market, and I've done incredibly well. So I'm looking a little bit away from financials right now. I'm complementing my travel exposure because, again, I think the consumer can do well under some of these GST reforms and strong economic growth. So complementing Interglobe with companies like and Make My Trip, adding to some positioning there, which is a name we've talked about in the past, but also quick commerce. So Eternal has been a winner of mine that I've added to my portfolio this year, but complementing that with a Swiggy, where valuation, I would argue, is very, very fair. Analysts continue to upgrade their estimates for the company, and you're starting to see a reduction in their cash burn, as well as an increase in their gross order volumes, thanks to some of the Max Saver program that they've implemented. So that name to me looks like it's climbing, and I think this is an attractive point to get into. And also Paytm. Again, it benefits from more spending. There's been favorable government reforms, and I think that they can continue to monetize a lot of the users that they brought into their ecosystem. So again, payments is related to the overall consumer that I think is going to continue to do well.
Okay, a little cut some positions in financials, added in consumers, Eternal, Swiggy, Paytm. Thanks very much, Matt. It's always great speaking with you here on CNBC TV 18. Look forward to the next one. Thank you.